perfect.
Yeah, so Brian, we're gonna go. We'll just go ahead and kick it off, and this is our first inaugural one for this particular group.
Okay.
So you'll get the full force of us, but we'll keep it casual, and um, we'll kind of explain to you our goals and what we're doing and why we're doing it, and
Okay.
happy to help. And by the way, I do have some multifamily investor contacts there in your area. So just as a follow up, I'd be happy. If you're looking to connect up and network with anybody local beyond what you're already doing, happy to do the introduction.
Yeah, that would be fantastic. Because there's a lot about the multifamily that the group that I'm with right now just isn't hitting on. Like how to, a perfect example is like how to analyze a property to see if it's worth investing in. When they're doing like single family homes, but like multifamilies, like quadplexes up to apartments, and the commercial side of things, which is really what I need. And then the second thing I need is like financing, educate myself on the best ways to finance these things.
Okay. Yeah, those are great. Those are also topics that we'll be covering. So awesome. Okay. Well, and Denny, do you want to go ahead and share the agenda?
Yeah, let's go for it. Can you see that all right?
Yeah, looks good. So so welcome. I'm Chris Freeman.
My name is Denny Lee, principal of Logic REI.
And this is a multifamily masters meetup. This is the Portland chapter. And so we're part of a larger organization. Think of it as like a franchise for the multifamily masters brand, and we're the Portland franchise, if you will. But as part of that meetup organization, the great thing about it is we create the opportunity for people that are in our meetup to get visibility and insight into other multifamily master meetup groups across the country. So maybe there's a particular topic that you want to see, and maybe we're not going to talk about analyzing a multifamily deal for 2 months, but maybe another chapter is going to be covering it. And if they're virtual, you can jump in, and there'll be more of these that'll go back to an in-person style over time. But the beauty is we are in a virtual world, so it doesn't matter where you live. Yeah, so for the schedule, we'll keep this like I said, we'll keep this light. We're kind of already did the introduction. So Denny, will you keep an eye if somebody joins? Actually, I'll see it because I'll
I'm not sure if I can see.
Yeah, I forgot. I'll see it when they pop up.
Okay.
Actually, let me see if I should make you a co-host here.
Oh.
No, not that option. Okay.
Oh,
but anyways, for the schedule, we'll keep it light. Today we're really going to talk about sort of the basics of why invest in multifamily specifically for passive income. And the goal is to keep this educational as well as network. And over time, the content and what we focus on will really be driven by the members and the feedback we get, and the topics or the speakers that they want to see. And we'll open up for some Q&A and chat and share some information or some insight or best practice or answer some questions, and then wrap it up.
So announcements are the next multifamily masters meetup is tomorrow, April 8th at 5:30 p.m. This one's the LA chapter. The next one after that is Texas, April 14th at 4:30 p.m. One after that is Durango, April 26th at 6:30 p.m. and Burbank, LA on April 28th at 5 p.m.
Yeah, and we will follow up with the link to the main Multifamily Masters website page so you can see the full schedule and see if there's anything there that piques your interest.
Introducing myself, my name is Denny Lee, like I said before. I'm the principal of Logic REI. I've been investing since 2015. Currently, I have a 12 unit that's under contract. I just recently started looking into multifamily deals in 2020, around mid 2020. And some of the main objectives of Meetup is to network, add value, and also receive value in return. So hopefully we bring that to you today, Brian. My motivation is to build a business that I love, solving problems and networking with others.
Yeah, and I'm Chris Freeman. So my my company is a Pacific Pine Property, and I've been investing in multifamily for 20 years. A very slow and grow strategy, but currently we have 110 units that we own and operate, and I'm invested in as a limited partner in another 355 units. And I'm passionate about the multifamily space. So even when I'm not operating it, I'm a big believer in the power and the growth of investing your dollars in the multifamily space. And working with Denny, I was very excited to really start to ramp up, our local Portland meetup, because I'm a big believer that you never know it all. And as soon as you think you do, you're probably in a lot of trouble, because then you're probably a little bit too confident. And we can always learn more, and we can usually learn it from other people. Everybody has something to add and value to bring to any discussion. And kind of what motivates me, the reason I am so passionate and focused on the multifamily space is to create some more financial freedom and more time to do what's really important to me, is really helping to build kind of the next generation of leaders, because somebody's going to need to take over and hopefully do it better than we're doing it. And personally, I'm a scoutmaster for my son's Boy Scout troop, and he's about a month away from being an Eagle. And I really learned, it was an eye-opening process for me. I learned a lot over the years, just how much potential there is in our youth when given the right opportunity, direction, and vision. So, that's something I'll continue to focus on over time.
The mission statement of Multifamily Masters: it's a global grassroots community to connect, educate, and empower people to build wealth through real estate. Disclaimer: what you learned here is not considered legal or financial advice. Please consult a legal financial professional for your specific situation. What you learned here is for entertainment purposes only.
And I really hope we can provide some entertainment. I'm sure I'll do something if I can have a gaffe or a mistake that provides some entertainment, that's value right there. All right. So why invest in multifamily for passive income? Let's start with, I think the more important question is why now, right? I mean, it's not like multifamily or apartments is a new thing, but why is now the right time to invest? If you look at right now, the home ownership rates across the United States, once we've recovered and normalized from the recession, we're still at roughly 1980s levels of home ownership. Granted, the population is higher, but the percentage relative to the population, we're at the 1980s level. And there's probably a number of reasons for that. I'm not an economist, but there's a general trend that kind of the average age right now would rather rent than own. Why don't you jump to the next slide? And a big reason for that is just sort of the change in demographics. And if people are marrying later in life, so I know my parents got married, they were probably old. They're 23. When I got married, we were 30, and I think that age is getting pushed out. And so, if you're not getting married, you're not in a rush to go buy the home next to the school district or get the home with the backyard so the kids can play in it, and you're not ready to lock yourself down. And there's a lot of people still living at home. I was blown away when I saw the statistic that 52% of people ages 18 to 24 still living at home. And then I don't think this is all that surprising, but 50% of the 18 to 34-year-olds have no steady partner. And the number I kind of keyed in on here is you take the figure they're ready to move out of their mom and dad's home at the age of 24. So from 24 to 34, they're not even really having a steady partner yet. They're definitely not out buying a home for the most part. They want the flexibility. They don't want to be locked down to a big mortgage payment. And so, that just creates good demand for apartment living, and more importantly, affordable apartment living.
So these are the 5 main ways to create cash or make money through real estate investing. So the first one is cash flow. All of these pillars are very important in real estate investing, but cash flow is one of the main ones that many people look at when they're analyzing a deal. So cash flow is the total gross income minus the total expenses. And the cash flow is what you receive to either invest back into your investments or for you to use in your everyday use. The next one is appreciation. Appreciation is the value growth of your property that occurs with the market for a residential property. For a commercial property or a 5+ unit, appreciation is the value growth of your property that you can force appreciate. We'll go into more detail on that in the next slide. And you also don't want to buy a property and hope it appreciates. You always want to buy a property and look for the cash flow. The next one is, next way to make money is rent appreciation. So once you see positive cash flow, you'll want to keep it on appreciating your rent. A conservative rent growth per year is approximately 2% growth. And usually when you do your analysis, you want to analyze it within a 7 to 10 year period. And let's say for specifically an Oregon market, you can only raise your rent by 9%. So let's say you can raise your rent by 9% this year. Next year, it might be 1 to 2%. So the 2% is usually the average out for the 7 to 10 years. After that is the mortgage paydown. So when you're renting out your property, the tenant is paying your rent. So that's also paying your mortgage. And the last one is depreciation. So this one is how it affects your taxes. And this one can get pretty convoluted, but every single property that you own depreciates. Residential property depreciates over 27.5 years, which means you can tax deduct from your rental income, which essentially turns into 100% cash at the end of the year. That means that you don't have to pay taxes for it, depending on how you do it. Cost segregation is a whole nother subject. Usually for a much larger property, usually around a multifamily, possibly around 20 or more units, kind of depending on the location, the cash flow that you're making from it. But cost segregation is when a tax when a tax person looks at your property and depreciates your property much quicker than it normally does due to the normal depreciation. So the cost segregation, they look at your stove, they look at your laundry, look at your roof, ceiling, they look at every single part, and that all those different items, they depreciate a lot quicker, which means you can tax deduct a lot more. So after hearing about all the regular real estate investing, or the general real estate investing, why multifamily? The main reason to go to multifamily is the ability to force appreciate. And the way to force appreciate is to increase your NOI. Your NOI is your net operating income, and your net operating income is the total income minus your expenses. So once your NOI is much higher, let's say you increase your rent, or you get the tenants to pay for part of the utilities, and then you also lower your expenses. Let's say you lower the water bill, lower the electrical bill, have your property manager possibly negotiate something on there, then you can also increase your NOI because of those different expenses that you decrease.
Yeah, I'll just give you a quick example of that. So we about 4 years ago, we purchased a property, a 22-unit building. I want to say it was around 1.2, maybe I think it was a little bit less than 1.2, maybe 1.1 and change. And it's kind of an older building, definitely mismanaged. The guy that owned it was really, really cheap. Didn't want to spend any money. Didn't really want to do anything. And for him, it worked. He was getting good cash flow. But as a result, he also wasn't really increasing the rents because he was limited for what he could do with the rents because of sort of the condition of the property and the way he managed it. But he's getting older. His wife was sick, and so he had to sell it. And so we bought it. And just over time, with tenant turnover, we started just doing some basic stuff, some new carpets, changed out some of these older light fixtures and threw in few new appliances here and there, some faucets, really just cleaned it up a little bit. We were able to, and he was renting it out for like 550, 585. As we started to put new tenants in there, we were getting 750, now $800. And what that did was the net operating income went way up. And now we're going to look to sell it and 1031 exchange it into something else if we can find something else. And the market analysis and what some of the brokers have put on it now is 1.9 million. And so over 4 years, 1.1 and change to 1.9. That's not because the area got any better. In fact, it's not even that great of an area. It's purely the increase in the net operating income. We forced the appreciation.
Nice. So the next reason to invest in multifamily is the improved cash flow. So if you're investing in a single family home or a 1 unit, your cash flow is limited. But let's say you have if you have a 10 unit, then your cash flow is increased significantly. And there's also economies of scale. Economies of scale, it makes sense for you to hire a property manager for a larger multifamily versus a single family property. You'll most likely be managing that yourself. And if you do hire a property manager out for a single family home, all of your cash flow will pretty much be, most of it will be gone to pay that property manager on that smaller property. Chris also has an example of economies of scale.
Yeah, just think about it. Typical. A lot of people start off in real estate, and maybe they start flipping homes or flip them, or buy them, fix them up, keep them as rentals. Maybe house hack, live in one, fix it up, then move on to the next one and start building up their portfolio that way. And there's nothing wrong with that. But the challenge is, and we actually have one individual home right now that we bought out of foreclosure. The challenge is, you need to fix something. You send the service guy out there to go repair it, and you never know what you're going to get because everyone's different. And you get out there and they don't have the part. They never have the parts. And then they got to go to Ace Hardware. Ace Hardware didn't have the part. Then they have to go to Home Depot, or they can't get the part at all. So then they have to wait, order it, and then come back at a different time. And that just costs you money. The next thing you know, what's a small plumbing issue ends up being a big plumbing issue in terms of time and money. When you get more units, you can get some consistency. But what's also important to keep in mind is not all multifamily is the same. You could have 40 units, and this kind of goes into the idea of making sure when you're evaluating your deal, looking at the consistency between the units. If all 40 units are kind of hodgepodge of units and different, and whatever, you lose out on some of that economies of scale. Kind of an example of that is we were looking at a 40 unit property in Albany, Oregon, and it turns out it was really 20 duplex style buildings that made up the 40 unit complex. And the price was right. I mean, in terms of just general price per door relative to everything else. But when you started looking at 20 roofs, 20 driveways, every one of these properties had a big tree or 2 big trees. And if you've ever had to go service a big tree, that's not cheap. 20 gutters to clean, just was not interesting. Versus, you take a 40 unit property, 2 buildings, maybe, they're consistent. Instead of having to go run out to Home Depot or Ace Hardware, you have consistency maybe in the plumbing pieces. So you can have inventory of the shower handles, the faucets, the light fixtures, the couplers, everything that you might need. You can basically have some inventory. And so your trip is to the storage unit or the storage shed to go get that stuff. And, just saves you a ton of time and lowers your costs, which ends up improving your cash flow. And
there's also a low vacancy rate. So if you have a single family home, 1 unit, that would be 100% vacant if there's no tenant living in there. But if it's a 10 unit, then you only have 1 person that's not living there, then that's a 10% vacancy or still 90% occupied. So there's a huge benefit of having 10% vacancy versus 100% vacancy.
Yeah, and it's part of there's a couple ways to invest in multifamily real estate. Actively, which is what I'm doing right now, or passively, which I'm also doing. So I was just going to touch for a few minutes on kind of the value of the passive income that can be generated from multifamily. Denny, want to? So, if you're looking at this space, you probably already have an appreciation of why you might want to look at multifamily investments. But it's sort of proven already that anybody that's wealthy out there that has built up a net worth usually has some real estate in their portfolio. Sometimes they directly own it. Sometimes it's a part of just a general passive investment, but they have it. Why don't we jump to that? And I guess, I'm sorry, what I was going to point out here is, you've got a couple options. You can go invest your money in the market. Nothing wrong with that. Dollar cost average over time, stick it into your 401k, take advantage of the matching and, build some net worth over time. But, it doesn't get you to the same level that, the people that have invested in real estate get to. And part of the reason for that is because you're investing in a real business, a real asset that generating income that you can use to feed back into that same type of asset to reinvest, and you start to get a little bit more of the bigger hockey stick of it. The modest investor, yeah, maybe that's a little bit more up and to the right than what the slide reflects. But I'll give you an example. So I invested in as a passive investor in a large apartment deal, 200 plus units. And good preferred return. So getting some nice cash flow from that. But over a period of years, they fixed it up, improved it, increased the rents. And then once that was more or less done, after about 4 years, they refinanced it. And when they refinanced it, they pulled money out, paid the investors back their initial capital. So I won't say what I put in, but let's just say it was $100,000. At that 4-year point during that refinance, they gave me my $100,000 back. I'm still in the deal. I'm still getting a return and I'm sharing in the profits, but now I have that $100,000 back and I can take that, which I did, and put it into the next passive investment. And so that's how you start to increase that more compounding growth while it's still kicking off cash flow. So why don't you kick to the next slide, Denny? And that's kind of the beauty of the multifamily piece is, once you get to that goal down the road of retirement, right? Your W-2 job, well, you're gonna stop earning income from that, and you're gonna start living off of your modest invested portfolio, mostly stocks, bonds, whatever it is. But at that point, right, your cash flow from the drawdown of that investment is going to be fairly consistent in that investment. Maybe it grows a little bit with the market, maybe not. It depends how conservative you are. But your cash flow most likely isn't going to grow unless you just start taking more from the invested portfolio. Whereas with the passive investment in real estate, you continue you get your cash flow. And let's say you have a point where you get some of your capital back, you put that back into the next deal, you're getting the cash flow from that. And so your cash flow actually continues to grow, even though you're not working anymore on it, just leveraging what you've already put in. And you want to jump to the next one? So, I mean, this is just a visual, right? We all start off in life for the most part. You get out of college, you start working. I'm still working. I still have a W-2 job, but you're working to get your income. And really the goal with kind of the passive investment side of real estate versus the active is getting to the point to where your money's working for you. You're getting income from the money you put in over time without having to actually do as much of the work. Now, the point that I really want to make, whenever I talk to any of my friends that ask me all the time about, how do they get into their real estate business, is it's not a get rich quick. I've been doing it for 20 years and, we only have 110 doors, and you'll see these people that'll talk about 3,000 doors, 5,000 doors. At the end of the day, that's just a number. Really what matters is what kind of cash flow are you actually getting? If you have a small 1% of 500 doors, that's probably not much. So, what's important is consistency, getting started, maybe it's a duplex. That's great. Get the duplex, work it, upgrade it into a 4-plex, 8-plex, and continue to grow over time. And at some point, you get sort of the snowball effect where you kind of wake up one day and you got great cash flow and fantastic wealth built up within the asset itself.
Okay, that's our last slide. Brian, do you have any questions or comments?
A couple. Like, I guess the first one would be going back to Chris, that 20 or 22 door apartment complex that you were able to invest in, and one of the things I'm